Welcome to our midweek Forex and Futures forecast. My name is Jay Norris. I'm the Director of Education at Trading University. We also need to remind you that trading involves risk of loss and is not suitable for everybody. In addition, these are real-time market snapshots that may not be replicated going forward. First market we're looking at is the Australian US dollar. The Aussie made a higher high earlier in the week, took out the September high. That's going to point to likely higher prices. That would be particularly interesting if you're a shorter term trader. We think that you've got room just above 97 even or so. So, maybe another 150 pips on the upside. As short-term traders, we'd still be interested in buying dips in this market in anticipation of those slightly higher prices. Next market we're looking at is the Euro US dollar. The Euro's been getting choppy in here. This is a daily chart. Not surprising given all the given and take in Washington. Overall, however, when you look at the euro for the month of October, you're pretty much unchanged, and you really couldn't get any traction either way. So, that indecision, not necessarily good for the bulls. I think the bulls overall still probably have the momentum here. I was really hoping we'd get a double top at the 2013 high here. That's a 2-year high. I was really hoping they'd test that level, if only to knock some stops out up there. Then I think you're in a position to correct this market. For now, just indecisive. You're sowing in, you're potentially sowing in resistance here. I mean, that kind of looks like distribution, but a little bit early to say. I think if we take a look, pan out to the weekly chart, you still have the momentum on the way up there, although your RSI starting to roll lower there also. But I was really hoping that, if we could eclipse that high right there, then that may set us up for a larger correction lower. We'll have to see. Euro loves these long-term double tops. That's what I was looking for. Next market we'll cover will be the dollar yen. Dollar yen, I think, is looking good. Of course, I tend to be a dollar bull, so I'm going to say that. I've been advocating buying dips in dollar yen all year, and you see why, because that's been working. No change here. So I think, this is a pretty bullish development. I know shorter term, you actually shifted your 20-day pattern higher here. So all your short-term patterns are lined up bullish here. In fact, some of those longer-term ones are too. So, this is a market where you're seeing what we love to see in a market. The short-term trend is bullish and that longer-term trend is bullish. So we think that'll outweigh this somewhat intermediate-term trend, which is still weighing on it too. So, we're not gonna switch horses now. We've been saying buying dips all along, and now you got it. So we're gonna stick with it. So we like dollar yen on the upside. Here's another one where short-term trader, you're certainly looking to buy dips, otherwise looking for buy signals, but longer term too, looking pretty interesting. Here's the U.S. stock market. It's a bull. What can you say? You definitely shook off the government shutdown. You shook off the debt ceiling. This market's a tough market. It's pretty interesting. You have to take markets in perspective. Now, you look at a long-term chart of this, and you see this massive rally. You're thinking, oh boy, that's that market's got to come down, or that's a bubble waiting to be pricked. On the other hand, when you take the long view of it, look at a monthly chart, and you realize, well, the S&Ps back in 2000 were at in the 1500 handle. Now they're only in the 1700 handle. So when you look at this market, what it's done over the last 13 years, it really hasn't gone far. So again, perspective is everything in this business. You have this massive double top at 1600. This could be just a potential breakout here with the market having gone nowhere for a full decade. Now maybe you're playing catch up. So you can't rule out more upside just because shorter term it looks like it needs to have a correction. Wouldn't mind seeing a correction, but a little late for that. If ever there was a time for a correction, this was it, and we had it, and that's all they gave you. That was all they're going to give you. I think now it was by the rumor as far as everyone realized they'll get stuff on back. They'll get things back on track in Washington. The market paid no attention to the congressmen, those minority Republican congressmen, paid them no heed and snapped right back in line. Now, I don't necessarily see a big breakout here either. I think it was buy the rumor and not necessarily sell the fact, because there's probably more upside here, but I think your upside will be a little bit slower than it had been in the past few days, and then what it had been, at the when you made a new high here. Generally, anytime you make a new high in the market, you've seen accelerations. The exception here, you slow down a little bit, but yeah, I don't necessarily see a big acceleration from here. I think this rally will tend to slow down. You definitely wouldn't want to be short, though. Let's take a look at the commodities now. Corn, it's a market I'm looking at overall. I think, you get the harvest out of the way, and potentially you have a market that you'll consider dollar cost averaging, because you can see corn, it's come down quite a bit from where these highs. Let's look at the futures, though, the commodity, to put it in perspective. There's corn, and you can see I've got a buy zone carved out there. So 400's the bottom of the buy zone. Now, if we had some kind of a double bottom or some kind of formation in that zone, I'll take a closer look at it. We don't have that yet, though. So to me, I wouldn't mind seeing $4 in the corn. If I go all the way out to a monthly chart, you'll see that $4 used to be the old high in this market. $4 was considered a high back in the 70s and the 80s. Now, if we see, as so often the case of markets, the old high becomes the floor, then we could anticipate support potentially at $4. So we like $4 in the corn. We think on the approach to $4, once you start getting, $4.20, $4.15, $4.10, maybe you take a look at that ETF corn, the exchange traded fund, and you start to buy a little bit, start to dollar cost average that in the ETF. So that'd be closer to 32, I guess. And boy, if you can get that, then even the 29 handle, that'd be worth taking a look at, the ETF corn. So that'd be something to look at, a potential investment, potential target to dollar cost average that guy. Let's take a look at gold. By no means am I a gold bug. However, I've been saying all along, if you have a double bottom potentially around $1,200, that may be worth looking at. You can see I've got that big buy zone drawn there. That's taken from that zone I have drawn. That's taken from the '08 low, and we've drawn that up, and that gives us that RTT level, that risk tolerance threshold buy zone. Well, you need at least a double bottom in there. So that's interesting to me. If you get a double bottom somewhere around 11 3/4, 12, that's going to be interesting to me. I overheard someone saying, gold, the problem with gold is there are no fundamentals. And I thought, that's a strange thing to say. There's no fundamentals for gold. But if you think about it, there really aren't, and I kind of understand that, as far as there's no earnings, as far as, there's really no supply numbers that come out to speak of on a regular basis. So it is kind of funny. You don't have the best fundamentals. The fundamentals in gold is really just momentum. Here's what's a concern about gold now. Let's say you bought gold every $200. Okay, you started buying at $600, and then you bought it again at $800, at $10, at $1,000, at $1,200, $1,400, $1,600, $1,800. Okay. Let's say you bought a little gold, equal amount of gold at each level, $1,000 at each level. Guess what your average price is now? 12. So you bought gold the whole way up from '08 on up, and you bought it right. And at the end of the day, your average is 12. You were breaking even in the summer. That to me is a concern, because if you think about that, someone's going to think, "Wow, you know what? I bought this. It went up, went up, went up." And I'm so close to break even now. What happens if it gets a little bit below their break even? Well, as soon as they go negative on it, they're going to be like, wow, that's the first time I'm negative on this trade in 5-6 years. Guess what's going to happen? They'll probably get spooked out of that trade. So, that's a concern for me. But I would like, I'm by no means a gold bug, but, I think we got to take a look at a potential double bottom at 12 even. But really, this is a big level to 1,100. So between 1,100 and 1,200, big level. We'll see if we get support at 12. The one thing you can count on, that every gold bug in the world is already long. Okay, they've got their bottom dollar in this market already. So that the fundamental here is that everybody who's long it, who likes it, is already well long it. Not the most attractive market now. Now, had you bought the stock market in that same manner since '08, if you were buying the stock market on the way up, Yeah, you got a little bit rocky for you in 08, 09, but on the other hand, if you continue to buy it, you're doing quite well. So I guess what I'm getting at is an investor in the stock market over the last 5 years would have done a lot better than an investor in the gold market. And you got to weigh that all out. There's no doubt about it. Not everyone's a gold bug, so they're just going to look at that, apples to orange comparison and go, hey, I'm going to go with the stock market with Apple and instead of the gold, the orange, just based on numbers. Next market would be the crude oil. Numbers are important, right? I'm excited about this. We finally have a turn lower in crude oil. This is a weekly chart. Here we'll drop down to a daily chart. And, I think there's room below. You can see we had that drew that trend line last time. You finally eclipsed that trend line. I think there's plenty of room below in this market. We're excited. We filled up the tank at $3.24 last weekend. It came up a little bit the past week or so, but $3.25 is pretty darn cheap for gas in the Midwest. So if you breach 100 and you pick up some momentum, we're going to be paying, we could be paying under $3 a gallon for gas. So we're excited in America about lower crude oil prices. So like to see more of the same of that. No surprise, continued weakness in commodities. Crude oil was one of the last commodities, and that's starting to give way too. So, things looking not too bad, right? You got a strong stock market. You have lower commodity prices. Hey, lower interest rates too. Here's the 10-year note market in the U.S., the U.S. 10s, and you look at this market, and it's headed back up, right? Pulled around today. This is very interesting on that the debt ceiling news, and that's it. The debt ceiling is probably bigger than the government opening, although, hey, if you work for the government, nothing's bigger than getting to go back to work, right? Surprisingly, the 10-year, the treasuries rallied on that news, so they reversed back higher here. So that's lower interest rates. As treasuries go higher, that means lower interest rates. So you really have everything going in the U.S. economy here. Here, I'll pan out to a weekly chart and give you the bigger picture here. And I was looking at this too, that area where it bottomed at. You take the 2010 low right there, and you mark the 2010 low, and you go up to the 2012 high, and then you draw your RTT level. And look at that, bam, price got right in that zone and turned around. So what's interesting to me here is that you retraced nearly 100% of that last leg down. So that tells me that there's a possibility that you're probably going to do a 50% retracement of this last bear leg here, and that means that notes potentially drift up towards 128, and that would mean lower interest rates for now. So again, you got a lot of things going on in the U.S. economy right now. Lower interest rates being one of them, lower commodity prices, that's a good thing. Strong stock market, definitely. Now you're in a position where the minority Republican Party kind of got punched in the nose here, and now you're in a position if you can actually. It's interesting. You have everything in the markets going for the economy now. Heaven forbid if the politicians could ever sit down and hammer out, some reasonable budget agreements, then you'd finally have the politics working for the government, working for the U.S. also. But the bottom line is commodities are cooperating. Certainly the stock market's cooperating, and interest rates continue to stay low also. So a lot of good things going on in the U.S. right now. Thank you so much for attending. Again, as always, we reminded that trading involves risk of loss. My name is Jay Norris. I'm Director of Education at Trading University, and thank you so much for attending.